everyone. Welcome to another episode of Crypto and Cocktails, the official 10-7 podcast. My name, as always, is Tyler. This is our man of the hour,
Tim.
And this is our dog of the hour,
Diggs.
We don't usually have Diggs around just because he's pretty rambunctious, but I guess we wanted to let him say hi to the people for a little bit. You want to say hi, buddy? Say hi, buddy?
Like, what am I doing here?
He doesn't know where he is.
Right.
He's like, where's my stick? I want to chew on my stick.
Right.
Oh, there he goes. But yeah, today, funny boy.
Give him the blazing saddles. Harumph.
He might be barking here and there.
I didn't get a harumph from you.
Oh.
See, it gets him going every time.
Yeah, exactly. You might hear a harumph or two from this little guy. But anyway, today we're going to be talking about something pretty important. But before we do, tonight's cocktail, obviously, as you can see right here, is something much more, I would say, intricate and also, in a way, beautiful than last week's cocktail, which was a very simple. This, on the other hand, is a Mezcal Margarita. Really? Because we're going to be burning down an old idea that no longer belongs in a modern portfolio. The myth of diversification. So.
Oh, is that today's episode?
It is, yes. So what better way to burn down? Salud.
Let's put to bed the 60-40 portfolio.
Hell yeah.
MPT diversification.
Ooh. It's actually good.
That's tasty.
I was expecting I wasn't going to like it, but I actually kind of do like that. That's interesting.
Very cool.
But no, so that leads in nicely, obviously. I mean, real quick, I got to talk about what's in this. There's a whole bunch of amazing things in this. Like, I think we specifically, you got like Dos Madeiras for this?
I think so.
Yeah. I mean, you could use any mezcal or any, Mexican rum, but
everything that we're focusing on and doing today is a very clean, low toxin stuff.
Mm-hmm.
There's actually a really cool app we found, and actually my mom had it and was using it in the grocery store. I was laughing. It's an app called Yuka.
Not sponsored.
Yeah, not sponsored.
But if you do want to sponsor us, let us know.
No, I think they're more of a collaborative crowd-funded app. So I don't know that they're going to have sponsorships per se, but it's YUKA.
They should, though. It's so good.
And you scan every barcode, and it just goes through all the ingredients, additives, and stuff like that. It has a 0 to 100 scale, what's good, what's not good.
Yeah.
And it's basically the blockchain in the grocery store, right? So
that's a good analogy.
We're going to get to the point where you're going to walk into Whole Foods, scan the piece of beef, and you're going to get the entire history of that entire cow, all the way from where it was born, what it ate its entire life, how it was raised, was it humanely treated, soup to nuts. And it's already here.
Or more accurately, farm to bowl.
Yeah, farm to bowl. So the funny part was when my parents were visiting 2 weekends ago, and I was in the grocery store with your brothers and sisters, and I just gave them the phone. They all downloaded the app on their phone, and they went to all their favorite stuff, and they started scanning their chips and their snacks.
Oh my
and
God.
Stuff. So bad.
And it was eye-opening for them, I imagine.
Got peanut butter Ritz crackers, 0 out of 100. And here are 5 ingredients that are toxic and bad for your health.
Mm-hmm.
Uh-oh.
I mean, that's why, people say it ad nauseum, but I can't help but say it myself. That's why if you look at, say Europe, for example, and you compare it to America, that's why Americans are just so much more fat, because our companies get away with putting so much more crap into our food.
I don't know that I agree with that.
Why so?
It's a lifestyle difference.
Well, sure, there's also that element. But I mean, if you look at the regulations behind what companies can and can't do in Europe versus in America, there is so much less in America.
The European countries poison their people in different ways. I think the spirit of entrepreneurship is way greater in America than it is maybe in the European
that's true.
nations.
Yeah.
So when you're an entrepreneur and off on your own and building, dude, you're not sleeping. It's 24/7. So there's stress that plays a factor into it. There's all sorts of stuff.
Yeah.
But it's it is what it is. Everything will balance out. But the point of it is now it'll be very interesting to see grocery stores get cleaned up.
Oh yeah,
Like,
and we've seen that before.
and then what you do is you could donate, right? So you donate money, because the money goes to the group that runs the app, and it's totally voluntary. But as a bonus, they say if you donate money, then they open up the search engine, so it's not just about scanning. You could track, have your favorites, search anything. And I'm a big macaroni and cheese guy. I've always loved macaroni and cheese.
He loves macaroni and cheese.
So I usually make a macaroni and cheese and then do, some sort of protein with it. And I went through and I found like 2 of the top rated macaroni and cheeses.
Mm-hmm.
And they're very high on the scale. They're actually vegan based.
Really?
Which doesn't bother me because I was vegetarian vegan for a while. So
Hold on, no, hold on. I did not, and I'm kind of surprised I didn't know this, but I did not know this.
yeah.
You were vegan for a while?
Yeah.
When was this?
Before I met your mother.
That explains a lot. Never mind, carry on.
She said if you don't eat meat, then we can't be together. So I took her right over to this place. It was called Menton, which was in a seaport area in Boston. I don't even know if it's there anymore. It was like Menton. It was below Sportello on Congress Street, I think. Right? Is that Congress?
All the restaurants in the
It was
seaport area
It
are
was like
beautiful.
down in the basement, so went over and grabbed a burger, and it was like the best tasting burger ever.
Well, yeah, because when you haven't had meat for such a long time, then you bite into meat, it's like you're, seeing the face of God. It's like, that's how I felt when I went to Georgie's for the first time.
Oh, jeez, yeah. But no, I mean, when I used to run like long distance marathons and stuff, I ran a pretty lean diet.
Is that why?
You had to find a balance though, because what I found is, you can't really have a tie to being a specific way around eating, right? And for me, there are things that I hate wasting my energy on. Not to go on a off topic or anything, but it's like I don't want to think about the food I'm eating. Like, I don't understand organic in a grocery store and non-organic. Shouldn't everything in a grocery store be organic? That baffles me.
Well, it's cheaper.
But why? It's food. It should all be organic.
You think the companies care?
Whatever. It's like when I look at my closet too. It's like the last thing I want to have to do is try to pick out an outfit every day. Just give me a nice looking shirt, a good pair of shorts, a pullover or hoodie, a good pair of shoes or sandals, and I'm out the door.
And the companies know that, and the companies say these suckers are gonna just eat up whatever the hell we serve them. If it's cheaper, we can save money.
Well, whatever. But the point is, it's like so much time and energy getting spent into just figuring out how to eat. But at that time, it was like you have to fuel your system. It doesn't matter. You have to fuel your system for what the activity level is and for what your body needs.
Yeah, my mom once told me your body's like a machine. You have to think of it as you're fueling a machine.
For sure. It's like a quantum computer.
It's like getting gas for your car.
Yeah, it's the highest powered quantum computer in all the universe.
Mm-hmm.
When you get to the crux of it.
I mean, we still haven't fully understood the human brain. But no,
waves and cycles, baby.
To get back on topic, we were talking about groceries.
Speaking of waves and cycles, let's talk about the ever-changing grocery store and how it ties to the dynamics of diversification and investment analysis.
We were talking about eggs, and it's funny because there's a phrase that goes so well with this analogy. Don't put your eggs all in one basket.
Oh yeah.
For decades, that phrase. See what I did there? For decades, that phrase, don't put your eggs in one basket was gospel. If you don't know that much about, like the world of, financial advisors and like really just that whole, like if you don't know much about that whole world, most likely the first thing you're going to think of when you think of like, oh, what would a financial advisor tell me is, oh, make sure you're diversified. Make sure you have a whole bunch of investments and blah, 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 blah. And sure, it made...
Which is the worst possible investment advice ever.
Yeah, and sure, it made sense in a world of like 8% bonds and stable currencies and mutual funds that actually beat inflation, but the world is not that simple anymore.
No, but it's never been like that, right? Like, diversification is a compliance term, and it's a compliance theme. And it was made up and invented to prevent people from blowing up by going too risky on something. Because at the end of the day, the markets are one big casino, right? So you have people that ultimately blow themselves up and don't take responsibility for their behaviors and try to blame it on who they work with, right?
Yeah.
Good or bad. Sometimes there are bad apples out there for sure, but modern portfolio theory and diversification, it's just made up classroom talk, right? So when I worked at BlackRock,
Mm-hmm.
and we had access to, but we still have access to the Aladdin system. So BlackRock was known for risk management and the way they could dissect a portfolio and how deep down they could get into their exposures. So a client would come to you, whether a trust, a foundation, an institution, a retail person, and say, here are all the investments that we have, right? The power of the Aladdin system, it would analyze every risk of every investment to the nth degree that you have and tell you how correlated you are. And when you're buying stocks, bonds, and cash in today's times, when the government's intervened with the system in 2008, and instead of letting Merrill Lynch go out of business and Goldman Sachs go out of business and other firms go out of business, and and told them they were too big to fail, you essentially broke capitalism and the free market system. So now everything is correlated to whatever decision making the Federal Reserve Board makes on interest rates.
Yeah.
Because every investment in America is tied to the strength and the value of the US dollar. That's it. It's a rate game. That's why when Jerome Powell comes out, we're not changing rates. Computers read the news, market drops. Oh, we're getting 3 rate changes by the end of the year. Computers read the news, markets go up. Hint, hint. Like, when you could have someone come to us and say, okay, run my portfolio through Aladdin and tell me what risk I have. You're going to see that when you have, okay, I have large cap value, large cap growth, large blend, mid cap value, mid blend, blah, 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 small cap, whatever. You essentially own the same category. Same with bonds, same with cash. So really you own the same investment. So everything that you have in a 60-40 portfolio is correlated to each other, and there's no escape valve now.
Yeah, the 60-40 portfolio is no longer balanced. Like, it's a relic. It's trying to keep your money safe in a world that doesn't exist.
Well, the theory behind 60-40 was you had 40% was fixed income producing investments. Bonds don't make sense anymore. Like, why would I buy a bond that makes me 3 to 5%? My value debasement on currency is 8% a year. So there's negative, 5 to 3% I'm already losing, plus inflation. So if I buy a bond, I'm guaranteeing myself at least a 6% loss year over year. And that's if I own the physical bond, right? If I buy the bond ETF, if you look at some of the treasury bonds out there, they're getting just absolutely crushed. And when you have a bond fund, as it happened in 2008, your bond fund crashes 20%, which should never happen. You don't own a bond, you own an equity. It's an allocation of bonds that behave like equities.
Yeah, and
so 60-40 is actually one investment with zero diversification. And this is where you start having to look at and think about, it's not diversification, it's asset and country segmentation.
Yeah, and on that note as well, like on the note of equities, like equities in particular, I mean, it's not just bonds, like cash is no longer neutral. It's obviously being eroded by debasement, government overreach, but equities as well, they're over concentrated in like a handful of tech names. Like that's not diversification. It's like passive exposure to like 5 CEOs. And then meanwhile your private bank like sells you alternative investments, fund of funds, structured products, private credit. Like it's all with layers of fees and limited liquidity. Like, it's not strategy, it's financial productized mediocrity.
Yeah, that's a good way to put it. It's productized mediocrity. You're right. That's a pretty good way to put it. Because it is, like even things that are called alternative investments that are sold on a lot of these platforms, they're not true alternative investments. They're funds of funds, they're packaged products, they're non-stock bond cash in the way that they look, but they behave a lot like stock bond cash.
Mm-hmm.
So, yeah, I mean, if you really want, you know, real investment segmentation, and this is the other part of diversification, which I don't think makes sense. You tell me one wealthy person that got wealthy off of diversification.
Yeah.
If you have an opportunity, you go all in on the opportunity. That's how wealthy get wealthy. It's not, oh, you know what, I decided to jump into real estate, but I wanted to hedge my bets, so I put my money in bonds over here and my bank over here. No. It's, I found an opportunity in real estate. I want to build an empire in real estate. I'm 1,000,000% in, unless and until I either make it or I don't. That's investing. Investing is where are you going to make money, not let's diversify.
Yeah, like, especially, I mean, let's take real estate for example. You know, an example of someone who, you know, got wealthy, who's very famous, is the president. He was almost exclusively in real estate. I mean, he had investments in various other places, but like he was known as like the up and coming real estate guy, the property developer.
The debt king.
Yeah. Like that was his thing. Or like, you know, Elon Musk, for example. Like he's got a billion different companies now, but...
Did Steve Jobs become wealthy because he diversified his investments?
Yeah.
And actually, it's funny, the guy who invented diversification, when he died, his portfolio, he owned 3 stocks.
That's very interesting.
Yeah.
You know,
do as I say, I don't do as I do.
Diversification is so important. Please ignore my portfolio.
Right. But think about it, like, I have this conversation all the time because there's a difference between risk management and diversification. So don't correlate the two because they're different. Because we're very honed in on risk management. That's the most important thing you can do, especially when you're dialing up empires and legacies and all that jazz. Like diversification, it's like, okay, so you get some portfolio constructor that comes in, they build your portfolio, and you look at it, you go through the year, like, oh, we do tax harvesting. Well, what's tax harvesting? Well, we capture gains and offset with losses. Well, if I have $500,000 worth of gains, why do I have $100,000 worth of losses?
Yeah, exactly.
What are you talking about? You make money by saying, okay, I'm taking my $1 million of gains that I have a tax bill, where do I put the money and how do I structure it to offset the taxes? Your biggest problem as an advisor should be when you go at the end of the year and you try to find losses in your accounts that you don't have any.
Yeah.
That's investment management, not diversification.
So this then leads me to sort of the next component of this, which is, I guess, you know, what is diversification in 2025? And this is where, like, you know, Bitcoin and Ethereum as digital-based layers comes in. This is where real yield crypto protocols for cash flow comes in. This is where tokenized real estate. In the last episode, we were talking about a whole bunch of real estate properties, big buildings and whatnot, are being tokenized now. Hard assets. This is where physical gold and uranium plays comes in, you know, as an example. Income generating media, IP content, you know, stuff like this podcast. That's where that comes in. And a treasury structure that sits outside the fiat system. That's what, I mean, that's what sort of the new diversification of the digital age looks like, would you say? Like, what are your thoughts on that?
I would say the concept of diversification doesn't exist anymore. I would call it, it's a return to the core. It's a return to real investment management and asset management. It's risk management and it's investment strategy. It's not diversification.
So a better term...
if you're looking at it, you're saying, okay, over the next 3 to 5 years, what are going to be the best opportunities for my money to invest. Okay? Traditional real estate, gone. It's over. You can't get into real estate anymore on your own. Single property stuff, rental incomes, doesn't make sense anymore. That's a dead asset class. So real estate, as it's been done for the last 100 years, is over. So I have to rethink, if I want real estate exposure, how to do that. And there are ways to do it. There are direct participation programs, there are interval funds, there are all sorts of avenues for real estate exposure out there that are pooled investments that are non-publicly traded. That makes sense. But the days of, I'm going to go buy 5 properties and rent them out, forget it. You're going to get killed on cost, you're going to get killed on taxes, you're going to get killed on HOAs, you're going to get killed across the board. And then at the end of the day, you're going to look at yourself like, every time you pick up the phone to get a call from a renter, it's just not worth the time and energy anymore. The margins are not there. So unless you're a big company and buying massive communities where you can, basically leverage up the spreads, like in the futures trading markets, real estate is a terrible investment now, as it's been done to date. So digital assets. Huge on digital assets. Cryptocurrency is the future of finance. It's not even the future, it's already here. We know it's going to be here for the next 50 years. There you go. So you need to have exposure to Bitcoin. Like, I think Bitcoin's like the gold standard. It's digital gold. I mean, they're literally telling you this from the U.S. government. Our strategic reserve includes Bitcoin and Ethereum and XRP. And
they've also started referring to Ethereum as now a digital oil.
I saw that. They called Ethereum digital oil, black gold. Makes sense. I always termed it more digital silver. But if you want to go oil and give XRP silver, although I kind of feel they should be flip-flopped on that one.
Well, XRP is a whole other beast. XRP is really going to be
It's a different system.
It's really going to be one of the cornerstones of how this whole thing evolves. It's in a league of its own.
But Ethereum is the play for major institutions. It's not a retail investment. It's not built for retail. Mm-hmm. It's built for financial institutions.
Okay.
Luna Stellar, I think, or I just call it, Stellar. Mm-hmm. It's XLM. That's the retail equivalent of XRP from what I've been able to gather and kind of how I, with the homework I've done. But at the end of the day, okay, so let's go back to those people that have a 60-40 portfolio, even 401ks. So now I need 10 to 40%, according to Rick Edelman, has to go into crypto. You can buy the ETFs, which are great, but they're going to have tracking errors, so the performance is not going to be spot on. And then I also talk with people about ownership, right? Because if you're building wealth, you need ownership. It doesn't have to be in your name, so if anyone heard that and like, oh, it's got to be Trust LLC, whatever, like, calm down a second, please. But what I mean is, where do you stand on the capital stack? So if you have a company like Apple, and you have the original stock in the company, you have all the bond holders and all the preferred stocks and all the debt issuers, and then you have you got all these layers of ownership up here, and then you cut it off and then go to what's distributed to the markets through traditional bond structures for capital raises, and then common stock. If Apple goes to zero and goes bankrupt, everybody down the line gets paid out, mm-hmm. except bondholders and common stock.
Yeah.
Below preferred stock, you don't really have any ownership. If the company goes under, you go to zero. Everybody else gets paid out first. So when we talk with people about investing, it's not just about, like, do I own Apple or not? It's, if you own Apple, where on that capital stack are you? Because you have to risk manage your way through that investment. And I don't want to put my money into something that if it goes to zero, that I don't be made whole. Right?
Yeah.
Like, and trust me, there's a whole other layer of homework and stuff that goes into this, but if you're thinking about investing, you have to think about your ownership too. What do I really own here? And if you own an ETF, you own nothing more than a number on a computer screen. Mutual fund, possibly could you own the stock, but it really is owned by the fund. So you buy the stock, do you get the stock cert in the mail anymore? No, not really. And your proxy vote goes to whatever custodian holds it. So you got to start thinking about things from an ownership perspective. So then you have, okay, I have my equity exposures, which I like, make sure I have the ownership. I have my digital assets. I now have my treasury, which I need to rebuild with, now it's Bitcoin at the core with a treasury, right?
Mm-hmm.
And then from there, 40% of what was traditionally the 60-40 portfolio is now going to alternative investments in digital assets. So that's 40% of everyone's portfolio across the country in retail space is going to shift to this new space.
Yeah.
And then what are my alternative asset exposures? Real estate, digital, warehouse, industrial, non-market stuff, non-correlated, income producing, growth focused, combination of the two, private credit, private equity, hedge fund. Like, do you have that stuff? And you need it, because now's the time. This shift is not going to wait for you to make this move. And if you're going to wait 2 years, really by the time this whole shift happens, it's going to be too late. And then from there, you have to say, okay, now I got to look at my commodities and physical assets.
Yeah, so that kind of leads me into, I guess, sort of a question about terminology, just because I guess all of this risk management, all of this, changing the focus as it relates to, where finance is going, where the markets are going, where the resources are going. What I originally termed the quote-unquote new diversification, and then you mentioned that's probably not the best term. What would you say a better term for that would be? Would it be just risk management or something else? If you had to sum it up. Because obviously, the old program, the term for that was, which we've been discussing now on this episode, diversification, and why that, just doesn't make any sense anymore. What would we call this if you had to nail something down?
Investment architecture.
Why so?
Building a skyscraper.
That's a good analogy.
Right. So if I have to build a skyscraper, I think of my wealth as a skyscraper, right?
Mm-hmm.
Or as a kingdom, and I have to build a castle.
Yeah.
At the core of my castle, I have to have what in order for it to survive thousands of years? Well, one, I have to have a really, really good foundation. Two, I have to have a really, really solid core. And then three, I have to have the ancillary stuff. And then on the fourth, I got to have the niceties.
Yeah, so
I gotta have the bling, the glamour, the glitz, the niceties.
Yeah, so it's not just about, the old analogy.
You need the moat.
Yeah, so the old analogy, of the old system was, putting your eggs in various different baskets. The new analogy is, instead of that, think of it as you're building a castle or building a skyscraper. You're building.
It's investment architecture.
Mm-hmm.
It's not diversification. It's architecture.
Yeah, and that's what people need to.
And when you get into it, especially like from a mechanical engineering perspective, when you're designing things, every little nuance of every little part of whatever you're building matters.
Yeah, I mean that's what we do. Like, we design capital structures. Like we build on digital rails. With downside protection, engineered through crypto native instruments, that can weather dollar collapse, sovereign overreach, or market contagion, all that stuff. Like, people, and it's not just us, like, people are doing that.
We got put to the test during COVID, right?
Oh, yeah, that's a great example.
COVID's a great example. I loved COVID.
I mean, I loved it too. I think we all secretly loved it.
We were really early in the stages, and a lot of this, when we were building it with our core clients that we had at that point in time, that we were able to implement and fully implement our structure and the investment architecture that we do.
Mm-hmm.
I think when the markets in, 2020, they dropped like 35-40%?
I mean, people were going nuts and saying, like, we're going to have a full-on depression. I mean, in retrospect, we already were, and we have been since 2008 because they never fixed that. But, like, people were like the whole system was coming apart at such a rate where like now everybody was noticing.
Right. At the worst part in that, I think, for the ones that we had the market plus the non-market stuff working together, our market stuff was down maybe 10, 12%. Our other stuff on the screen was down 5%. And that didn't include all of the private and physical stuff we owned, like silver and gold, that popped.
Yeah.
And then we were like, well, we're sitting on a bunch of cash, so
we're Michael Burry.
Wing.
like people like us, and it wasn't just us, but people like us who, you know, were ahead of the curve on this. Maybe obviously didn't see a massive global pandemic coming, but
we're
saw
like Mikey at the end of Rounders, all in.
Yeah, but like we saw the broader financial situation coming. You know, we were ahead of the curve on this,
anyone really saw COVID coming.
No, but I mean the broader financial situation, like where the future of finance was going, pandemic or no. The pandemic just accelerated it.
The pandemic accelerated it. The Biden administration was a pause to what's inevitably going to happen now.
Mm-hmm.
But yeah, I mean, I was loving it. And I like volatility. I love when the markets crash. I love when you get the drops because that's buying opportunity, really.
Buy the dip.
Buy the dip, as they say in the crypto space. And the whole point is that's where diversification, like I would have other people call me and they're like, I'm like, how you doing? And they're like, buried. They're getting calls from their clients, panic, blah, blah, blah. I'm like, dude, we're cool.
I don't get it. Why am I being buried? I'm diversified.
My bond fund is down 22% and my equities are down 46%. How's diversification working for you? And that's the point. There is no diversification if you own stocks, bonds, and cash. You own all the same thing.
It doesn't matter how many...
That's where the difference is, not to interrupt, sorry.
No.
The difference is risk management. Know where you could take your shots, know where you shouldn't take your shots, and marry the two together.
Yeah, no, that's all I was going to say. I was going to say, like, it doesn't matter where, like, it doesn't matter if you put your eggs in a million different baskets if the system is all crushing all of those eggs at the same time.
Right.
You know, you can put your eggs in various different baskets and watch the system crush them, or you can build a castle around all of those eggs and the system won't be able to crush the freaking castle.
Well, and the thing that I think about, too, it's like, okay, let's say you have the end of the world in Armageddon.
Well, we were supposed to have it in 2012 and it didn't happen, but I was terrified.
But this is a little bit about my thought process, right? And it goes back to like when we talked about the Great Depression. Let's say you have basically the end of the world. Well, who's wealthy on the other side and best living life on the other side? That's the position I want to be in.
Exactly.
I want to be in the position that no matter what anything in the world does, that people we work with are in that position, right? Like the Great Depression, everyone talks about the despair and the poverty and blah, blah, blah. Oh, we ran out of money. It's like, well, we print money, so it's kind of like saying we ran out of inches.
Yeah, and also nobody talks about every time there's a market crash, like every time there's one of these events that happens. I mean, it was a lot more talked about in the wake of 2008 just because, you know, the media and the technology has developed to such a degree. But even with the Great Depression, even with, you know, the various panics in the 19th century, every time there's been a massive market crash somewhere in the world, there's always people who understand what's coming and they make tons and tons and tons of money.
Right. And you have the modern banking system was born out of the Great Depression. Medicare, Medicaid, the entire system, which is now fallen apart, was born out of the Great Depression. So now we're going through a new economic transition. And if you architect your investments and your finances properly, you will do whatever you want to do because you're going to be in a great position to accumulate more wealth and opportunity.
Yeah.
And it's kind of a new day, a new dawn. It's a new age. Making money is easier now. It's easier now than I think it ever has been. I mean, how many TikTok millionaires are out there?
Oh my God, so many.
And it doesn't matter, right? Like, whatever a person does, it could be dumb cat videos. No offense to cat owners out there, but like the creative economy is opening up massive amounts of opportunity. And instead of sitting around judging it, just go with it.
Mm-hmm.
Figure out, you know what? I remember busting my ass for years in corporate. And I was really successful in corporate. But man, it's like I'd be on a plane Sunday night, bounce around 3 time zones, home on a Friday, hang with my kid for the weekend, rinse, lather, repeat for 48 weeks out of the year. Yeah, I made great money. Would you call that work-life balance?
Absolutely not.
Did I run my own
There's
show?
no life.
Did I run my own show?
No.
Exactly. So now I'm like, well, my exponential return on my life is way better if I do it on my own. Technology is making that available to the masses now. And especially when we get this next wave of technology and AI that wipes out the middle people, especially on the white collar side, blue collar is going to do just fine.
Both information and money are becoming democratized at a rapid rate. Right. And, the scions of the old system are terrified of it.
Right. Well, and because they're being put out of business. So, like, for example...
Mm-hmm. Except for those who are embracing it. Because there are some that are embracing it because they have to.
Like, if I did this for a second, let me try something here. Hey, man, tell me about the 60-40 portfolio and the death of the 60-40 investment portfolio.
Sure, let's dive into it. So, the classic 60-40 portfolio, 60% stocks and 40% bonds, has traditionally been a go-to balance strategy for a lot of investors. It was considered a relatively stable mix because bonds would often act as a cushion when stocks got volatile. But in recent years, a lot of analysts and investors have been talking about the death of that 60-40 approach. Basically, with bond yields staying super low and both stocks and bonds sometimes moving in tandem, that traditional diversification benefit isn't as strong as it used to be. Plus, with inflation concerns and the rise of alternative assets like crypto or private equity, a lot of people are rethinking if a simple 60-40 split really makes sense for the future. In other words, the death of the 60-40 portfolio is just a way of saying that a lot of folks in the finance world think it's time to get more creative and flexible with asset allocation.
There you go. ChatGPT 5.0 just told you. I call him Jerry.
Simple and succinct.
Right, but the whole thing is technology is different now. ChatGPT, we just lost power.
Should I keep that in? I feel like I should keep that in. That's kind of funny.
That's funny. Well, we just lost power at the studio. Oh, it's back.
It's back.
That's awesome.
We'll jump cut. We'll jump cut in there.
Jump cut to that. Yeah, so with like ChatGPT and everything and technology and like even like they said, alternative investments in crypto, and 95% of advisors, 95+%, maybe more, don't do crypto. 91% don't do alternatives. So if you're an advisor and you're an investor, gotta start asking yourself this question because you don't have any more time to wait.
I feel like if anything, the fact that we lost power is a great analogy because hear me out, right? Hear me out. You can be as prepared as possible, or at least you can think you're prepared as possible. You can have all your different eggs in one basket. You can have, all your resources allocated to so-and-so. In the end, though, a thunderstorm is going to come through and it's going to knock all the power out at once, and there's nothing you can do to stop that. The lights went out. I mean, we got a generator, we got this and we got that, and everything came back on all nice, but the power did go out for a hot second.
Sure. Absolutely.
That's kind of what's happening in finance.
Risk management.
Yeah. So if you build that, if you build that castle for yourself, then, if a thunderstorm comes through, the power won't even go out. So I guess, we kind of have to build the castle a little bit more.
Right.
But I know there are homes out there that have like completely autonomous generator systems and power grids where, a freaking tornado could come through and the power would be on the entire time.
Yeah.
That's what people need to build for themselves in finance.
In life, too. We're definitely seeing a major shift with how people are thinking about their lives. We're watching a massive shift of populations and human movement across the world. I think it's going to be very, very interesting to see the next 5 years and how this plays out. And man, the more I watch it, the less involved I want to be. I want to be as far away from everybody as possible. It's really weird.
Yeah.
Right? Just land, structure,
sovereignty.
It's sovereignty. And I think for a long time, I think people have lost the idea of their own sovereignty. And I feel like we're definitely getting back to the roots a little bit.
Mm-hmm.
And everyone's realizing like this whole we are the world globalization thing, it just doesn't work. And really when you want to hone in on, you know, part of it is you have to just eliminate the distractions and all that stuff and really sit down and say, okay, where do I want to be with me and my family, and what do I want it to look like?
Mm-hmm.
And I look at it like I feel like my role as a father is to eliminate barriers and obstacles, right? So whenever any of you have a pursuit, then I'm here to help get rid of any obstacles that are in the way. So you don't have to worry about that. Like a lot of us grew up coming up from the 60s and 70s and 80s. I mean, we didn't have money, man. We were if you looked at it according to today's standards, we were poor, right? And we always had to worry about money. We ate food. It wasn't your highest quality food in terms of nutritional value. It was like if I could get milk, bread, protein, and a veggie, we're good,
mm-hmm.
right? But there was always this thing about, oh, I don't have enough money to do this or do that. And I think a lot of people that kind of came out of that world are now building, like we're the ones that are building this newer age of sovereignty for yourself and your family. And with today's times, the dropping of the ideas of what used to work from a financial perspective and seeing what's coming, especially with digital assets and technology,
mm-hmm.
it's going to provide a lot of opportunities for anyone that wants to just go out there and go get it done.
Mm-hmm.
Right?
Yeah, exactly. So I think that's a pretty good way to sum it up. I think we'll end it there, so we can go fix the lights. But, yeah, this has been... Yeah, I kind of want to see what's going on because it came out of nowhere.
Right.
It was sunny this morning and then it just came out of nowhere.
Wasn't on the radar.
Yeah. But, yeah, as always, my name is Tyler.
Tim.
This has been another episode of Crypto and Cocktails, the official 10-7 podcast. Be sure to like, subscribe, and share. And yeah, we'll see you guys all soon.
Cheers. Go Bills. It's a shout out to Josh Allen.